Lecture 6. In this lecture, we're going to cover two topics: reporting and analyzing inventories, and then reporting and analyzing long-term operating assets. Inventory is an asset, and then the cost of inventory, which is the cost of sales, is also reported in the income statement. And for some companies, this could be the largest single expenses in the company's income statement. For example, this is Walmart's income statement, in which Walmart reports cost of sales or cost of goods sold. Okay, it's almost 80%, more than 80% of, about 80% of the total revenue, total sales. So when inventory is purchased and or manufactured, it becomes an asset until inventory is sold. When inventory is sold, the cost will be transferred to cost goods sold, and reported in income statement. Right, we have seen this the definition of gross profit, which is sales less cost goods sold. Right, we have seen this before. So let's talk about recording for inventories. When inventory is purchased, okay, we increase inventories and we reduce cash, or if we purchase on account, right, we incur liability, so we're going to credit account payables instead of cash if we purchase on account. And if we have to pay the shipping cost, depend on the contract, right? Depend on the contract, which contract we have. If we have to pay transportation cost, it's also increase the cost of inventory. So we debit inventories, right? For example, $20 shipping cost, and the credit cash, $20. When we sell inventories, there's two journal entries to make. We all know that on the revenue side, we credit sales revenue. Also on the cost side, we're going to increase our cost, so we debit cost goods sold and reduce our inventories. Inventory cost, right, include cost of purchase, cost to acquire, we know that. And talk about transportation is also included in the cost of inventories. If we have to prepare inventories ready for its intended use, okay, the cost also increase the cost of inventories. If we consider any incentive like a purchase discount, okay, if we pay less to vendors, it's going to reduce the cost of inventory. When we report inventory, we have to consider, right, all inventories which we hold a legal title, although some of those inventories are not staying with us. Okay, they're not with us. For example, inventory on the road, we call this inventory in transition. Okay, we have to make sure whose inventory they are. Okay, depends on the purchase term or sales term. FOB shipping point. FOB shipping point, okay, that's inventory has been shipped from vendors to us. Shipping point, the legal title has been transferred at shipping point, meaning, right, when those inventories are on the road, okay, we hold title. As a buyer, we hold title of those inventories, and they should be reported on our balance sheet. Although they have not arrived at our warehouse yet, but they are our inventories. And sometimes we have shipped, right? We have shipped our products to customers, but we have not fulfilled the requirement for recognizing the revenues, so the title has not been transferred to the customer yet. Okay? In this case, they are still our inventories and should be reported on our balance sheet. And finally, when inventory is on consignment to a distributor. Okay, so we ask distributor to sell inventories for us. Okay, so distributor just consignors, they consignee, they don't own the title of those goods. So remember, we need to put those inventory back to our balance sheet. Alright, so on the balance sheet, usually we have these account for inventories. We have raw materials, work in process, and finished goods. Right, and this is an example of how inventories are reported on the manufacturer's balance sheet. And for retailers, right, merchandisers, there's only one account, inventories, for them. Right, how to calculate cost of goods sold? To understand how to calculate cost of goods sold, we need to understand how cost flows within companies for inventories. So let's take a look at this picture. So we have beginning inventory, right? Our cost will increase with purchase. Together, these are the total costs we have. Cost of goods available for sale, the total cost we have for our inventories. These inventories, these costs, either they're sold, okay, so the cost will flow to cost of goods sold, or they can only stay with us in our end inventories. So mathematically, this shows a relationship between these accounts. That is beginning inventory, right, plus purchase, right, equals cost of goods available for sale, and the cost of goods available for sale less end inventory must equals cost of goods sold. So this is a very easy way for us to calculate cost of goods sold, especially useful in periodic inventory system. I'm going to talk about that. So in a periodic inventory systems, okay, we don't record cost of goods sold or the reduction of inventories during the period. Rather, by the end of the period, we can account our end inventory and use this formula to calculate cost of goods sold. This is typically used by periodic inventory system. But for most companies, we are using perpetual inventory systems, so the cost of goods sold and the cost of inventories are recorded in real time, transaction by transactions. Okay. However, this formula is still useful to calculate cost of goods sold. To get the cost of inventories, we also need to learn about the cost flow assumptions. The three assumptions typically used for inventory cost. They are first in, first out, or FIFO, last in, first out, LIFO, or average cost method. So let's take a look at these examples. So the requirement is not to solve complicated questions, but we need to understand the concept and do simple calculations, okay, under these cost flow assumptions. All right, so let's take a look at FIFO, first in, first out. So assume we begin with 100 inventories, $4 each cost, and we have only two transactions during the period, right? One is purchase 400 at $4.50 each, and then we sell 460 at $12 each. Okay, only two transactions during the period. Now, under FIFO, okay, what is our cost of inventories and what is cost of goods sold? We're going to determine that. So the FIFO means first in, first out. So when we determine the cost of goods sold, we're going to assign the cost came in first, which is old cost. We're going to assign old cost to cost of goods sold. Now, when we sell 460 at $12 each, okay, we need to assign 460 unit of cost to cost of goods sold. Now we're going to consider assign $4 or $4.50 first. Under FIFO, we're gonna assign $4 first because these are old cost. Old cost must be assigned to cost of goods sold first. So 100 unit of $4 will be assigned, but that's not enough. We need another 360 unit, $4.50. Right, so this is how we arrived at $2,020 cost of goods sold under FIFO. Okay, then the remaining cost will stay in end inventory, which is $4.50 will stay in our end inventory. Right, we have 40 units left. Why? Right, 100 right plus 400, which is total unit we have 500, and we sold 460, so there must be 40 units left at $4.50. Look, these are new costs. So under FIFO, right, any inventory always carry with new cost. So if we understand FIFO, then LIFO is the opposite. When we sell, right, 460, we're gonna assign lasting first up. So the cost came in last will be assigned to cost of goods sold first. So, and the new cost, or the $4.50 will be assigned to cost of goods sold. Not enough. We need another 60 unit to cost $4. That's how we determine the cost of goods sold and then the end inventory. Remember, under FIFO, end inventory always carry with new cost, and under LIFO, end inventory always carry with old cost, $4. Look at cost of goods sold and the end inventory, right? The numbers are usually, most times, are different. All right, so this is a FIFO and a LIFO. To summarize, FIFO and LIFO both are historical cost method. Just we allocate cost. The way we allocate cost is different. Okay. Difference arises when cost inventory change over time. If the cost never change, okay, there's no difference between these two methods. When cost goes up or goes down, okay, these two methods are going to give us different result. And typically, when prices are always rising, which is the case, which is true for most products. So when price is rising, LIFO is typically will give us lower, right, higher cost of goods sold and lower net income. LIFO, and FIFO is giving us higher net income in most cases. Right, but the benefit of having a LIFO is, right, we have high expenses, so we pay less tax. That's a benefit of having a LIFO accounting. An average method is something in between. So when we determine the cost of goods sold and in inventory, we use the average cost we have. So remember, we have 100 plus 400, we have 500 units in total, and we calculate the per unit, right, cost for our inventories, $4.40. Right, that's how we determine the cost of goods sold and inventory under both three methods. Okay, remember we only have two transactions, one's purchase, one sales. Makes things easier to calculate. If we have multiple sales, multiple purchase, right, we especially under the perpetual inventory assistance, we have to analyze the cost of sold, and inventory transaction by transactions. Okay, but we're not going to go through those complicated cases in this class. All right, so next topic. Regardless of whether it's FIFO, LIFO, or average, they're all historical cost accounting. Okay, but for inventories, okay, we cannot stay with historical cost accountings. We have to consider the lower of cost or net realizable value. Inventory is reported on the balance sheet at LC/NRV, not historical cost accounting. But it's easy to understand. We know sometimes inventory value will goes down, so the net realizable value, okay, which is the value we can realize when we sell those inventories, will go down. When the value go down, company must write down the inventories, okay, and take the loss. However, it's not that case if the value goes up. When the net realizable value goes up, okay, we do nothing. Therefore, inventory is reported on the balance sheet at the lower of cost or net realizable value. In other words, we can only take the loss from inventory devaluation, but there's no gain for inventory appreciation. So when we take the loss, we can book a loss, or it can be part of the cost of sold. Okay. A journal entry is we debit loss on inventories and credit inventories, or we can debit cost of sold and credit inventories for LC/NRV accounting. Therefore, if someone asks you when inventory valuation is historical cost accounting, you say no. Yeah, they are LC/NRV. It's a hybrid mode. It could be historical cost, or it could be NRV, which is fair value or market value. Inventory disclosures. We're going to disclose inventories, everything about inventories. They're right. Cost flow assumptions and valuation method, lower of cost market. And here market means NRV value after 2017. Before 2017, it's called a low of cost or market, LCM, but after 2017, it's LC/NRV. Okay. There's many reasons for inventory disclosures because investors need to know more about inventories, especially the risk associated with inventory, and also it can provide insight into future performance. I remember we always are interested in understanding Apple's inventories about the iPhones, iPad, right? These kind of things, because we can by looking at analyzing the inventory changes, can better predict Apple's future performance. So what are the associated financial analysis with inventories? One is a gross profit margin. We have seen that before. Gross profit margin, right, measures company's profitability. This is the very first measure of profitability. The sales, that's gross profit, right, equals sales less cost of sold, and divided by sales again. It's going to give us the gross profit margin. And usually this is determined by the business or industries. Okay, for certain industries, gross profit margin will be higher, and for others, like grocery store, the gross profit margin will be lower. Many factors is going to affect the setter, right? If the product line, you have a very promising product lines, like for example Apple is always having a new iPhones, iPad, but their gross profit margin will be higher than their peers in the industries. And if there's some new competitors entering the market, right, everyone's gross profit margin will be lower, like the vehicle industries, automobile industries, when the electric vehicles entering the market, right? The old players, their gross profit margin will be lower. Right, by monitoring the company's gross profit margin, we can get a rough idea of how their profitability has been moving, either down, or for Home Depot, I think they're maintaining their profit margin. Maybe that's increasing, but we need to see more years. But for Lowe's, it's obvious they're reducing their gross profit margin. So if you are comparing these two companies, and if you are work for Lowe's, managers for Lowe's, okay, it's time to think about it, whether your product line is too stale, okay, or on the other hand, do you consider cost savings? It's time to consider cost saving, otherwise your net income will be much lower than your competitors. Right, another ratio is inventory turnover ratios. We have that indicator how quickly inventory is being sold, cost goods sold, divided by average inventory. Okay. A similar or a related ratio is average inventory days outstanding. Basically, it's 365 days divided by inventory turnover. This will give you the average inventory days outstanding. The longer, right, the inefficient your business is, because inventory stay with you for too long. Basically, when inventory stay with you, you incur a lot of cost, right? You have the capital cannot be used for other things. You have to invest capital inventories, and you have to store inventories. You have to maintain inventories. All these will cost you a lot of money. Alright, so these are ratio analyses. If you look at Home Depot's inventory days outstanding, it's relatively stable, but there are 2 days, okay, jumped from previous 2 years. It's a red flag. You need to take a look at what is happening. Okay, I believe that's maybe COVID related, but the 2021 report is going to show an even higher inventory days outstanding. Inventory turnover is affected by competitions, basically. But if you can change in product mix, you can have new product, okay, new product lines. Probably is going to increase your inventory turnover. If you have stable inventories, old inventories, it's going to lower inventory turnover. And if you have a high inventory turnover, you need to consider whether you have excess purchase or production. You have too many inventories, basically, or your inventories lacks trends, lacks attractions or technological advantages. Okay, or it's time to consider some promotion policies, right, to lower the price, give more incentive for customers to purchase. Well, these kind of things are related. By talking about improving asset utilizations, how to improve inventories in an efficient way, or how to optimize inventory investment. We know that too many inventories will be expensive, but too little will be risky, right? So there are several changes you may consider. Okay. For example, you can improve manufacturing process to eliminate bottlenecks and working process build-up. In other words, you're going to streamline your production manufacturing process. There are certain procedures that's going to be a bottleneck, so right, everything will stop there or build up in that process. Those are the process we want to streamline. Or you may have promote some of those strategies like just-in-time strategies, in which typically companies do not store inventories. Okay, when customer orders demand, okay, you're gonna right ask suppliers to send your raw materials, and you're gonna start manufacturing. But that requires a collaboration, close collaboration between your suppliers, right, and all your manufacturing facilities. But the result will be good, right? You're going to end up with very efficient inventory, okay, and it won't take you a lot of capitals on inventory investment. Right, this shows results for Home Depot and Lowe's. Okay, this is consistent with the gross profit, right? Gross profit margin lines. Looks like Home Depot is slightly more efficient than Lowe's in terms of inventory turnover, right?